Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 134. My name is Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. By night, I write the Best Interest blog. I host this podcast. I also put out a weekly email newsletter, all for free. And all of these different projects help busy professionals and retirees avoid mistakes and grow their wealth by hopefully simplifying their taxes, their investing, and their retirement planning. Today, we're going to do a deep dive episode all about Monte Carlo analysis. I've been working on this one for a little while. I've gotten some good questions over the years from listeners like you about kind of wanting to go into the details under the hood of Monte Carlo analysis. You're going to hear me say Monte Carlo analysis a lot today, just FYI. But before we dive into the details, we'll do our usual thing. We will do a review of the week. This one is from AppTrail1, who left a 5-star review and said, "Gold medal podcast. This podcast checks all the boxes: accurate, accessible, honest, and unbiased, all sprinkled with a little bit of dry wit." Well, AppTrail1, thank you very much for those kind words. You can shoot me an email to jesse@bestinterest.blog, and I'll get you hooked up with a super soft podcast t-shirt. Now, on to the main course today, the big show. We're talking about Monte Carlo analysis, what it is, what it isn't, how to use it, all those kind of things. If you haven't heard of it before, of course, we'll introduce it. But, this very quick preamble, I want you to think today that Monte Carlo analysis, this thing I'm about to talk about, it's not a crystal ball. But it is a stress testing tool. It is a very excellent conversation starter. It's not necessarily predictive though, right? It's not a predictive machine. It's not a crystal ball. The outputs from Monte Carlo analysis, things like a success percentage, for example, can be a double-edged sword. It does provide important data on whether you're thinking about retirement in the right way, but it can also hide different faulty assumptions. It can mask over-conservatism. It can mislead you emotionally. So today, we're going to dive into all those kind of things, and hopefully you leave today understanding why I begin with that preamble. Today, we're going to cover specifics like why we need to do in-depth analysis like Monte Carlo analysis, what's going on under the hood of a Monte Carlo analysis, how does it actually work, especially how does it work in financial planning? I mean, that's why we're here. Where can Monte Carlo analysis go wrong? How do you cautiously but accurately, or at least helpfully, interpret the results of a Monte Carlo analysis? And how do you make sure your Monte Carlo analysis, of course, isn't misleading you, right? How do we get led down the right path with these results instead of one of the many different wrong paths? So let's start with, why do we need to do in-depth analysis in the first place? I would argue that most of us have big hopes, but also maybe some big fears. We have big questions, certainly, about retirement. How do we answer those questions? Some questions can only be answered via conversation and looking within. Some questions are certainly subjective in nature, but plenty of these retirement questions at least, are objective, right? They're fact-based. They're based on numbers, plain and simple. But retirement has a bunch of different moving pieces and a lot of different numbers. And there are a lot of different ways that someone can begin to analyze their retirement plan. And when I say analyze, I mean use some form of numerical methods to determine if you can retire, how successful your retirement might be, how much you can spend, et cetera, et cetera. There are plenty of free, widely available online retirement calculators that usually provide something like a retirement score or a probability of success based on average static assumptions. And I think the key word there is static. And you'll hear me today use the word static and dynamic a few different times. So when I say a static assumption, these types of free online calculators, they often assume static unchanging earnings, static unchanging savings rates, static investment returns. 7% per year, 9% per year. It's just a static, one-size-fits-all, constant return. And that's fine. It's fine to use that type of tool as a general readiness check for retirement. But it's about as loose a rule of thumb as you could muster. If that type of static calculator suggests that you should, and I'm using air quotes, that you should have 4 times your income saved, but you only have 3 times your income saved, well, I still wouldn't know enough to know if you're truly behind or not, because the tool itself is too coarse to come up with that kind of conclusion. But then if that calculator suggests that you should have 4 times your income saved, and here you only have 1 times your income saved, well, then I might wager that you need to dig into the details a little bit deeper, because there's a good chance you're actually behind on your retirement savings. My point there is that these coarse, static online calculators, they're just that. They're coarse. It's hard to walk away with really good outputs and really good direction when you're using such a coarse tool. Now, if we dial up the complexity a little bit more, we might focus on something like a, quote unquote, deterministic cash flow modeling. So this type of tool allows for much more detail, such as specific retirement spending, maybe part-time work in retirement, big one-time expenses like your daughter's wedding or buying that vacation home. It helps you project future income, project future expenses, your net worth. It helps you project your net worth on a year-by-year basis. You can model in Social Security income, pension income, basic tax calculations in a way that is certainly more detailed than the previous course analysis, but also personalized to you, specific to your timeline. And that is all great. That is something we're looking for. We're moving in the right direction here. The problem, though, is that exercise, this deterministic cash flow model, it typically assumes a static investment return. The focus is on cash flow and the dynamic cash flow. It's not necessarily on dynamic investment returns. We know, though, that investment returns are a really vital component of retirement planning. And of course, that investment returns are dynamic in nature. So that's where, if we go one step further in terms of kind of the complexity of analysis types, that's usually where Monte Carlo analysis comes into play. Monte Carlo analysis is a more sophisticated analysis type that tests your financial plan, your retirement plan, against thousands of different possible market scenarios, rather than testing it against only one average static market return. So Monte Carlo might simulate market volatility to determine the probability of success, as in there's an 85% chance of success that your money will last you to age 95. Success is another one of these big words that we will come back to multiple times today. We need to talk about exactly what success means in this context. And like I said, we'll come back to that. So done well, a Monte Carlo analysis takes your unique projected cash flow that we just kind of talked about a minute ago. So your unique retirement cash flow, and then it layers that cash flow on top of a wide range of possible investment returns. And then it asks which types of investment returns, which series and sequence of investment returns could lead to bad retirement outcomes, could lead to really good retirement outcomes. I mean, what is the range of possibilities in your retirement future? So for example, we could walk away from a Monte Carlo analysis and look at it and say, well, in this analysis we ran, most kind of standard typical investment return series actually caused our retirement plan to fail. Oh, that doesn't really sound good. Or maybe we walk away and say, listen, only the worst of the worst investment series actually caused this retirement plan to fail. And that certainly sounds much better. Or maybe if we go even a step further, we'd see that our retirement cash flow actually survives even the very worst possible investment series that this Monte Carlo analysis could muster. And then we should ask ourselves, well, maybe we're being too conservative then, right? If our retirement fails even the worst scenario possible, are we just underspending our retirement? But before diving further into the specifics of financial planning Monte Carlos, because we will get into those specifics, I want to take a quick step backward. Maybe it's the little engineer in me. So how do Monte Carlos work in general? I think that's actually a really important place to start. And heck, why do we even call them Monte Carlos in the first place? So let's talk about that. Let's talk about how Monte Carlo analysis works in general. When you hear Monte Carlo simulation, Monte Carlo analysis, Monte Carlo anything, you should think lots and lots of random trials. That's what I want you to think. Lots and lots of random trials. For example, one might ask themselves, well, how often in poker, Texas Hold'em, does a player get dealt two aces? Now, a true statistician would be able to use actual statistical equations to answer that question, like probability equations. It's not that hard of a question to answer if you understand how many cards are in a deck and how statistics probability works. But you could also use Monte Carlo analysis to answer that question. You could teach a computer, you could program a computer to randomly deal out a 2-card hand and then have it repeat that random dealing another billion times, which for a computer, it's pretty fast to do a billion kind of those simulations. And over those billion random trials, a really accurate probability of a 2-ace hand will become apparent. So cards and dice and darts and I suppose other games of chance are easy targets for Monte Carlo simulations, but Monte Carlo can also be used on much more complex stuff like weather predictions. For example, when you see one of those spaghetti plots that a hurricane weather forecaster might use to show all the various paths that a hurricane might take, that's often a product of a Monte Carlo simulation. So these meteorological models use fluid dynamics, and fluid dynamics, one of my former courses as an engineer. Fluid dynamics is famously unpredictable, and that unpredictability can be somewhat tamed or at least understood by using Monte Carlo methods. So if you're unsure if the winds are going to shift faster or slower, well, you simulate both those outcomes a million times. If you're unsure whether the wind is going to shift east or west, you simulate both a million times. Is the hurricane going to move over warmer waters or colder waters? A hurricane's path might depend on a million different variables, and a Monte Carlo simulation allows you to take those million inputs, vary them a few different ways, and then output a huge range of results. And one set of inputs might say that Miami is going to get crushed by this hurricane, but another set predicts that the hurricane won't even make landfall. And over millions of simulations, a probability distribution emerges. And you might say, Miami is only going to get hit by this hurricane in 1/100% of the results. And that's a probability that you can probably live with. Now, Monte Carlo, I'm learning now kind of after the fact, was the name of a famous casino in Monaco, which is that French city-state, very wealthy city-state. And two mathematicians, including the very famous John von Neumann, developed the Monte Carlo method, and they named it after the gambling house, kind of thinking to themselves that they could use this method to look at darts and dice and cards. But the original purpose for Monte Carlo analysis was not fun and games. It was working on nuclear weapons at Los Alamos. I suppose if you're unsure how a high-energy neutron will penetrate into fissionable uranium, you might simulate that neutron's path a billion times and see what the results look like. We still use Monte Carlo analysis for a lot of different purposes today. We used it at my old job where we were designing and analyzing and building and testing satellite telescope systems. In fact, Monte Carlo analysis exists in lots of places in engineering. Here's an example. You know what turbulence feels like in a plane. Many of you have probably flown in a plane. Some flights are very smooth, some flights have a couple bumps, and some flights cause you to kind of yell out in terror and feel sick to your stomach. That's turbulence. Well, an orbital rocket flies about 30 times faster than a commercial jet. So you better believe there's some serious turbulence, atmospherical turbulence, when your telescope is getting a rocket ride out in space. But due to the chaotic nature of fluid dynamics, just like in the hurricane example, how do you model out that turbulence accurately? And more importantly, how do you model out the turbulence as it combines with some of the other uncertainties in your engineering design? Well, one way of doing it is by brute force of lots and lots of random trials. Monte Carlo analysis comes to the rescue in that situation. But in any numerical analysis, including Monte Carlo analysis, one of the biggest takeaways is that garbage in equals garbage out. And I suppose what I mean there is that, the accuracy of your inputs determines the accuracy of your outputs. If I'm trying to simulate, the odds of a particular poker outcome, but I accidentally model the deck of cards of having 50 cards instead of having 52 cards, I'm going to get the wrong answer. Everything else about my model could be correct and elegant and programmed efficiently. But if I made a major poor assumption, like the wrong number of cards in a deck, it's going to mess up my entire analysis. So that's an important lesson as we pivot towards specifically discussing Monte Carlo analysis for retirement planning. So let's start thinking about how your one unique retirement might play out. So you're sitting there at 50 or 55 or 60 or 65 years old, and you probably know some of the following. You probably know what your current asset base looks like. You know how much you have in the bank, how much you have in retirement accounts and a taxable brokerage. You know how much your house is worth, all those kind of things. Hopefully you understand your cash flow. You have good data on what you could spend. Importantly, you have a reasonable understanding about how your spending will change over time. You might not be totally precise there. After all, our crystal balls are foggy, but if you have, again, a big wedding to pay for, if you have ACA premiums when you're early retired or something like that. You understand roughly what your future spending looks like. Hopefully you know at least some of the details of your withdrawal strategy. You're aware of which accounts you'll be withdrawing assets from over time. If you're unsure, I recommend checking out episode 121 of this very podcast for some detail on the generally accepted retirement withdrawal framework. What you don't know, though, among other things, you certainly don't know how capital markets will behave over your 20 or 30 or 40 or more years of retirement. How will stocks and bonds and other assets perform? Will you be subjected to a generous or a harsh sequence of returns? That's something you don't know. And the first blush reaction is to simply assume some fixed rate of return, maybe be a little conservative with your fixed rate of return, and do that for the full 30 or 40 years of your retirement. And if all you have is a simple pocket calculator, that's probably the best you can do, and that's not a bad place to start. And that's one of those methods we talked about before, is try to get really accurate with your cash flow, and then assume some constant rate of returns and see how your retirement plan performs. But thanks to better and better computing over recent decades, we can do a Monte Carlo analysis here. Remember, Monte Carlo analysis simply means lots and lots of random trials. So instead of assuming one stream of investment returns and a constant stream of investment returns at that, we can assume many different streams of investment returns with some randomization in there. We can assume thousands of different variations on how the market could perform. And each one of these trials, each one of these 1,000 trials, is really a full financial life story in and of itself. A single simulation projects year-by-year portfolio returns, cash flows, taxes, withdrawals from today through the end of the planning horizon, whatever you define what the end of your planning horizon is. So here, the sequence of returns is really a feature of the analysis. It's not some sort of bug that we're trying to avoid. We want to see sequence of returns risk here. We want to see how impactful it is. And by shuffling the order of returns across these hundreds, if not thousands of different trials, the Monte Carlo analysis will explicitly capture that sequence of returns risk. And that's something that these deterministic projections that we talked about before, they completely ignore sequence of returns risk. We're going to spend more time in a few minutes talking about the specific inputs that go into a Monte Carlo analysis. But first, I actually want to dive into the output before we dive further into the inputs. We want to talk about the outputs. The output of a Monte Carlo run is a distribution of outcomes. It's not one single answer, it's a distribution of answers. So instead of one final portfolio value, you get a wide spread of final portfolio values. Some are terrific looking, some are mediocre, and some are catastrophic. Some show that you run out of money. But that's the entire point of doing the analysis in the first place. One thing that you see as an output is the so-called success rate. It's probably the headline output, the most viewed, the most cited output of a Monte Carlo run. In short, the success rate says, out of these 1,000 different trials, or however many you run, out of these 1,000 different trials, how many of those trials ended as a success? And typically by default, success means that you die with at least $1 of positive net worth. But it's very easy to tweak success if you want to be like, I want to die and gift $100,000 to each of my 5 grandkids. So now you need to die with 500 grand, and that's a success, or something like that. The most common result, again, is the percentage of trials that are successful. So by getting a 82% success rate, it means that 82% of the trials met your success criteria, but 18% failed your success criteria. And that's useful to know. But that simple number, 82% success, that simple number ignores the wide range of possible successes. It also ignores the wide range of possible failures. It ignores the scenarios where you almost ran out of money and you probably would have been really, really anxious about running out of money, but technically it was a success. It also ignores the scenarios where you barely ran out of money and you were really okay, except for bouncing the final check of your life, and it calls that a failure. The point is that success rate and those distributions of outcomes, it's a pretty blunt way of viewing the output of a Monte Carlo analysis. Another common output from Monte Carlo is the average net worth at death. That's another common output. If you look at the 1,000 scenarios that you run, it'll just say, let's take an average of what the net worth is in all 1,000 scenarios and report that back to the user. This too is useful, but a very blunt metric. It can be helpful to see how much your average net worth has changed over time in all the scenarios, but this one average kind of papers over all of the important details. I think I actually use this either in writing or in a previous episode. Imagine we have one scenario where you die with $10 million, and then we average that with 4 scenarios where you die with 0. You actually run out of money. The average of those 5 scenarios, 10 and then 4 zeros, the average is $2 million, which sounds great. If I told you, yeah, your average retirement, you will die with $2 million. A lot of you will say, well, that sounds good to me. That's kind of what I'm looking for. But what you might not realize is that the real important outcome from the data I just quoted you is that 80% of those 5 trials actually fail, right? 4 of the 5 are just abject failures. So again, the average net worth at death, there's some usefulness in that output. It masks over some important details. But okay, let me pause there because I'm going to come back in a little bit and I'm going to talk about better ways, at least in my opinion, to examine Monte Carlo outputs and results. Here's a quick ad and then we'll get back to the show. I love getting your questions, and some of you ask me questions about the wealth management firm I work for in Rochester, New York. Others ask about the Best Interest blog and this podcast, Personal Finance for Long-Term Investors, which operate without advertising, without pushy sales, and with no paywalls. How can the blog and podcast stay afloat without me dumping my own money into it? Well, to answer both those questions, I want to point you to episode 78 of Personal Finance for Long-Term Investors. I intentionally recorded episode 78 to shine light on those topics and inform you how you are actually helping and can continue helping these projects carry forward. So if you've ever been curious about the business of my blog and podcast, or if you're curious about my day job in wealth management,
please check out episode 78 and let me know what you think.
But let's pivot now. Let's talk a little bit more in depth under the hood about how Monte Carlo simulations work. And therefore, once we establish that, we can start to understand more about how Monte Carlos might go wrong, how to interpret the results that we get from one of these analyses, how to make sure that your Monte Carlo analysis isn't misleading you in some way. And usually the first place, the most common place where a Monte Carlo simulation or any kind of simulation or analysis can go wrong, it's just like in engineering, there's an aspect of garbage in, garbage out. And what that really means is that if the inputs into your mathematical model are bad, if that's the garbage in, then you just know that the outputs are going to be bad too. That's the garbage out. So it's really important that we try to provide really accurate inputs and that we try to understand how the inputs that we choose actually affect the outputs that we end up getting. So anyway, that's why it is imperative that we understand the inputs here, such that they play such a vital role in determining our outputs. It's almost like the Play-Doh machines, right? Where you stuff some Play-Doh in and you turn the crank and it shapes the Play-Doh in a certain way and then you get your output. It can be really important to understand what's going on when you turn that crank. And in the Monte Carlo world, there are really three unique ways that the math is kind of done underneath the hood when you're turning the crank. And I just want to talk on those three different ways really quick. The first method is called the independent identically distributed method, or independent identically distributed returns, because really we're talking about investment returns here. The second method is newer, but very interesting. It's called the block bootstrap approach. And then third, and the most common one, is the statistical distribution approach. They're all very similar, but they have some pretty important nuanced differences. To explain them simply, I want you to imagine that you're maybe creating a video game. It's kind of like SimCity or The Sims. You're building some sort of society in your game. And for whatever reason, it's important in this game that you model out the heights and the weights of the individual little digital people in the game. If you were given that problem, there are probably a few different ways that you could do that. The first idea that you think of is you could look up some health study that has actual height and weight data from, 100,000 different people. You upload all these heights and weights into your game, and then whenever you need to assign the height and weight to someone, some little digital person in your game, you could pull some of the actual real data that you've already uploaded, some of the real data from actual humans. The second idea is that you could kind of do the same thing, except maybe you could upload it in blocks, because what you'd say is, well, if I have a family, let's say I'm trying to determine the height and weight of one of my digital families, like their height and weights are probably all going to be correlated in some way, at least for the kids they are, right? Because if you have the same genetics, if you have the same parents, your height and your weight is probably correlated to your siblings in some way. That's a second method you could use. But then the third method is much more statistical in nature. You could just upload the average height for all people, the average weight for all people, and then some information about how those data are distributed. For example, you might describe them as, two bell curves with some standard deviation of 3 inches in height and 20 pounds in weight or something like that. And then when you need to create a person in the game with a height and a weight, you simply use some sort of random number generator to say, hey, take my averages, see where my random number falls in a bell curve, and assign that height and assign that weight to my digital person. So the first method is using only real data points. The second method is also using only real data points, but it recognizes that often these data points can be correlated to one another. They can be kind of grouped together. And then the third method is using real data originally to create a statistical model, but then technically it's really making up new data points that just so happen to fit within that same model. And these are the three ways that retirement Monte Carlo simulations are basically done. The first way is the independent identically distributed return. In this method, we are only using real data. We are not creating some sort of investment return or series of returns out of thin air. We are not saying that 10% is the average, so please create some sort of random number between minus 30 and plus 50% and make that my return this year. That's not what we're doing. Instead, we are taking historical returns, real returns. Sure, we're selecting them at random, and then we are kind of laying them in series with one another. So if we need, say, 50 years worth of returns to simulate our retirement, we would select 600, because that's 50 years, 600 months. We would select 600 random monthly returns from the existing historical return set to create a random time series, and we'd string those 600 months together. And this detail I'm about to say is important. In order to preserve the correlations between assets in each month, each asset would receive its, appropriate return from the same original month. So what I mean is that we aren't selecting a stock return from October of 1982 and pairing that up with a bond return from January of 1960, putting them in the same month in our simulation. The stock returns and the bond returns for month 1 are both going to be from October of 1924. And then the stock returns and the bond returns for month 2 are both going to be from January 1991. We're going to rinse and repeat that process month by month until we've filled up our entire simulation. And that's just one retirement run, right? So again, if we go back to the 50 years or the 600 months, we put together a series of 600 monthly returns, and that's simulation 1. But then we do it again, all random. We do it again for simulation 2, and then again for simulation 3, over again and over again and over again, another 1,000 times. So in that way, we built our Monte Carlo simulation with all these random returns. They are real data, right? From the real data set, we just kind of randomized the order in which those returns occur. Now, this next method is a variation of that independent, identically distributed return. This one's called the block bootstrap method. And the idea here is that we shouldn't take 1 month from 1928 and then follow it up with a month from 1961 and then a month from 1949 and 1997, et cetera. So that's what the independent, identically distributed return method does. But the reason that the block bootstrap method does something different is that we've kind of realized that whatever happened in that 1 month in 1928 is connected in some way to the month before it and the month after it and the month before that and the month after that. These economic cycles and bull markets and bear markets can take a long time to play out. So it doesn't make sense to pull one random month at a time. It might not even make sense to pull one random year at a time. Instead, the block bootstrap method suggests we take much longer blocks of returns, the most common length being 10 years of returns at a time. So to create a 30-year retirement simulation, we would grab 3 different 10-year blocks of returns and use those to simulate one full 30-year retirement. Each of those 10-year blocks would have some true long-term economic patterns within it. And then we do it again with 3 different 10-year blocks, and then again with 3 different 10-year blocks from that. And every time we're randomly selecting the start date for these different 10-year blocks. We do that over and over again, hundreds, if not thousands of times. Again, now we have a true Monte Carlo simulation with thousands of individual trials, all randomly selected. But rather than having 30 or 40 or 50 years worth of totally random monthly returns, the block bootstrap method carries some real economic oomph with it because the blocks have some sort of underlying patterns that more closely resemble reality. But that brings us to the third approach, which I think is the most common approach. It's certainly the one that I've seen most frequently. It's the statistical distribution approach. So this is the method that requires you to input an average rate of return based on the performance history of your specific assets or the performance history of your specific portfolio allocation. You input the average return. You also input information about the distribution of returns. For example, bell curves or normal distributions or Gaussian distributions. These all mean the same thing. A bell curve is a normal distribution, is a Gaussian distribution. It's probably the most common type of statistical distribution that people are used to, even if they might not be aware that they're used to it. You're used to the fact that 95% of American men are somewhere between 5'5" and 6'5". And that it's much more rare, but not unheard of, to see someone who's 6'8", and it's much rarer still to see someone who's 7 foot tall, et cetera, et cetera. That's because height data matches a bell curve. It matches a normal distribution. This is the mathematical distributions that just so happens to accurately describe the way that height data is distributed amongst a large population. And whenever you're trying to describe the way a bell curve looks, it's important that you define the average of that curve. It's also very important that you define the standard deviation, or a measure of how quickly the bell, as it were, kind of dissipates down as you move away from the average. But there are other types of distributions too. There's log normal distributions and power law distributions and Poisson distributions that all actually do have a place in financial modeling of some sort. But the really big problem with using a statistical distribution to model out investment returns is that no single statistical distribution seems to model investment returns that accurately. So I'll say that again. There's no statistical distribution that models investment returns as accurately as we would want them to be modeled. For example, the normal distribution, the classic bell curve, this is the distribution that many Monte Carlo simulations actually use. If your Monte Carlo software of choice is using an average return plus a standard deviation, I'd wager under the hood it's using the standard bell curve, the normal distribution, the Gaussian distribution. But the problem is that the stock market, investment markets, they have these crazy days and crazy weeks and crazy months, maybe even crazy years that we've heard of before. We're used to the idea that, yeah, once in a while, like April of 2025, the market did happen to drop, 9% in one day. And then the next day it was back up 9% again. The problem is that if we use the way a standard distribution really works, and if we look at how infrequent those really rare events are supposed to happen, a standard distribution says that something might be a 1 in 1,000 year event. And if we're talking about the height of a human and we say, well, if we're going to get a human who's 9 feet tall, odds are one is going to be born every 500 years. Well, there aren't many 9-foot tall people walking around. And bell curve's way of describing the frequency of 9-foot tall men actually plays out in reality. But when we use a bell curve, a normal distribution to describe the stock market, we have these events that should be 1 in every 1,000 years, but we see those events occurring way too frequently in real life because the normal distribution has very thin tails. The normal distribution says that, the market dropping 8% in one day ought to occur once in a million trading days, except it's occurred 8 different times in the last 10,000 trading days. It's just not a accurate a way of describing market behavior. The good news, it seems, is that the normal distribution does become more and more acceptable at longer time frames. Meaning if we needed to model daily market returns, the normal distribution would be a very bad choice of doing that. Totally inappropriate. There are just too many crazy days up or down in the market for the normal distribution to accurately model it. But if I'm modeling 1 year returns, then suddenly the bell curve becomes not perfect per se, but certainly better, much better. It turns out that the most accurate way to create real-world market returns is just to use an actual data set of real-world market returns and not to let a statistical distribution kind of create those market returns for you out of thin air. But many commercially available Monte Carlo software packages do use a bell curve, a simple bell curve, a normal distribution to distribute and randomize their returns. Bolden, for example, is a very popular DIY financial planning software, which includes a Monte Carlo package, and a lot of DIY financial planners out there use it. It has a Monte Carlo simulation based on a normal distribution curve, a bell curve, and it uses the average rate of return and the reasonable standard deviation that you input into the software to create your Monte Carlo output. Now, if you're really curious, it seems like the Laplace distribution is at least better at capturing the fat tail nature of the stock market. And I can throw a link into the show notes that kind of has an overlay of a bell curve and a Laplace curve if you want to see them on top of each other. But I don't have a statistics degree, and most of you don't either. And the good news is that we don't really need a statistics degree to be able to run a Monte Carlo analysis, right? We're all going to be okay. I think it's just worth understanding that there are different ways to do any sort of numerical method underneath the hood. And it's just important to know that the method that you choose has a bearing on the output. It might not impact the output a ton. And that's where, if you understand what's going on under the hood, then you can make that kind of value judgment for yourself. Am I willing to accept any sort of error that's going to occur because of the numerical method that I'm picking here? I think that's why they say there's a very common phrase in the world of numerical modeling that all models are wrong, but some are useful. Like if you're doing some sort of statistical method like the ones we've been describing, you know that your answers are going to be wrong. Like no answer that you get from any Monte Carlo is going to perfectly match the one unique pathway that lies ahead of you for the next 30 years. Of course that's not going to happen, right? We know that. But we also know that these models can be really useful in explaining the range of possible outcomes that we might live through. As long as you understand what kind of errors you're introducing into your range, you're going to be okay. But next, whether we're using a normal distribution or some other distribution, the important inputs of a Monte Carlo actually aren't quite done yet, because with any distribution, we need to define the parameters of that distribution. We need to define what average actually means, and we need to define how quickly the curve flattens out, how the data is dispersed within the distribution. And whether we're talking about a normal distribution or a Laplace distribution, or for many statistical distributions, that term is called the standard deviation or the variance. And in investment lingo, we might use the word volatility instead. We're trying to define how volatile these assets are. So in Monte Carlo software, you'll often be asked to define the average return and the standard deviation of that return. Maybe you'll be asked about your portfolio as a whole, or maybe you'll be asked to define those data points for specific asset classes. So perhaps the software will already have those numbers programmed in so that you don't have to put them in. If you're inputting specific asset classes, so data for stocks, data for bonds, data for real estate, etc., then you'll also probably have to input the correlation for those assets. Stocks and bonds and real estate and all other capital assets, they don't behave independently in a vacuum. They behave in a dynamic world where they influence one another. So the return profiles of different assets are correlated to one another to varying degrees, and a proper Monte Carlo analysis will account for that. And maybe this goes without saying, but the more inaccurate your return assumptions are, the more error will end up in your results. So if you decide to be extra conservative with your return assumptions, then you have to accept that your failure rate is going to be skewed higher than it otherwise would be. If you underestimate the standard deviation in your portfolio, which yes, we can call volatility, if you underestimate the volatility in your portfolio, then your investment ride will be far smoother inside the Monte Carlo than in real life. And you'll probably end up underestimating just how the sequence of returns risk might negatively affect you. So typically, this is where we go consult history. We look at historical market data. We ask ourselves questions like, how has this asset or this portfolio performed over time? What's been the average return? How volatile has it been? And that becomes your input, or at least it should heavily guide your inputs. And then you let the Monte Carlo run. Okay, so what's going on when we let the Monte Carlo run? Again, the main inputs into a Monte Carlo simulation are typically your unique future cash flows, namely how much withdrawal out of the portfolio you're expecting on an annual basis, and then your portfolio return profile, both the average return and the expected volatility. And one thing you might have noticed by now is that since the return and the volatility and even the correlation between assets are single entries, you're usually assuming that you will have one portfolio allocation throughout retirement in a Monte Carlo run. So that's the way that most Monte Carlo programs operate, even if we know that a real retirement might look different. So even in something as dynamic as a Monte Carlo simulation, it requires even more dynamism to say, well, is this retiree going to be changing their investment allocation over time? Are they going to retire at 60-40 and then eventually go down to 50-50, only then to realize they have too much money and they're saving it for charity and their heirs and they go back up to 70-30? Like most of these software packages can't handle that level of dynamic complexity. So they just assume you have one single static allocation throughout your retirement, even if we know that might not be the way that your specific retirement will go. But the program takes your portfolio return, your expected volatility, and some form of a random number generator to create a decades-long sequence of returns that your portfolio will endure. And those returns, combined with your future outflows, that's all you need to see how your portfolio will fare in retirement. And then the program does it again, using the same average return and the same volatility, but now a different set of random numbers to create a different decades-long sequence of returns. Now you have a second version of how your portfolio fares. You can do that 10 times, you can do it 1,000 times, you could do it 1,000,000 times if you had enough time to do it. But either way, you now have many hypothetical retirement paths to examine. How do we interpret those results? How do we make sure your Monte Carlo isn't really misleading you in some way? As I alluded to earlier in the episode, the surface level results from Monte Carlo runs can leave out a little too much detail. I think we need to go deeper. So first, I think we need to discuss what failure means in the context of retirement planning or Monte Carlo analysis. Typically, Monte Carlo programs define failure as not meeting your end goal. And most of the time, that end goal is not running out of money at death. So to have at least $1 is deemed a success, and having anything less than $0 is deemed a failure. The second most common end goal, though, usually involves leaving assets to heirs or to charity at death. So again, if you want to leave 5 kids each $100,000, then in that case, anything less than $500,000 at death would be deemed a failure because you've said that's your end goal. That's pretty black and white. But imagine this, you retire at 55, things go well for a couple years, and then the market throws you some rough curveballs. You hit a pretty bad sequence of returns in your first decade, and you know that some of the smart ideas we discuss here, you decide to pare back your spending a little bit. You do what you can to mitigate sequence of returns risk as best you can, and because you take this evasive action, your retirement gets back on track, so to speak, and you live happily ever after. That is something that all of us have the power to do in our retirements. But a Monte Carlo analysis, at least the commercially available ones, do not model that for us in the least. Now, why not? Because what I just described there was dynamic. Based on the bad sequence of returns that we lived through in my hypothetical, we dynamically decided to decrease our spending. And then when things turned around, we dynamically decided to increase our spending again. Monte Carlo programs don't do that. Or again, it's not that they can't, it's just that such many different degrees of dynamic modeling, that's a challenge. It's a difficult challenge to program. And to be fair, it becomes a challenge for end users like us to implement that in a clear way. If you're looking at some sort of online software program where you have to input 100 different numbers in order to quote unquote model your retirement, it might prevent you from taking that next step and actually modeling it in the first place. It's too intimidating. It's too difficult. So in order to keep Monte Carlo simulations kind of on the simpler side, there are some dynamic things that we would normally do in real life that just are not part of standardly available software packages. But what it really means is that the failure percentage from a Monte Carlo analysis is misleading. What failure percentage, what it really should be thought of, is the likelihood that you might need to be dynamic in your retirement decisions. When your Monte Carlo run gets an 80% pass rate, it means that in 80% of realistic market conditions, you could literally go on autopilot and not run out of money. But in the other 20% that are deemed failures, but in those 20% of simulated market conditions, you would have to make a dynamic decision in order to achieve retirement success. It doesn't mean that you outright failed. It means that you would have failed if you were just on spending autopilot and withdrawal autopilot, but if you decided to be dynamic, you might have succeeded. Here's a quick ad, and then we'll get back to the show. I send a free weekly email to thousands of readers that shares 2 simple things, just 2. The first are my new articles and podcasts, so you'll never miss when I publish new content. And the second is my favorite financial content from other corners of the internet, so you can see what's been helping me the most.
But Jesse, I don't want another email.
I hear you. I make this newsletter short, sweet, and full of essential information, and readers enjoy that. About 85% of newsletter subscribers are engaging with the newsletter more than once a month. They're enjoying it, and you will too. You can subscribe for free on the homepage at bestinterest.blog, and you'll get a free PDF of my white paper titled The Step-by-Step Guide to Building Your Retirement Paycheck. That's right, a free weekly email that thousands of people like you are already reading, a free white paper to help you plan for retirement, and you can sign up for free at bestinterest.blog. And that brings us to another kind of challenge when it comes to interpreting Monte Carlo outputs. Imagine you run a Monte Carlo simulation with 1,000 different trials. And somewhere in those 1,000 trials, you're going to find 2 of those 1,000 that just so happen to be on either side of the failure line. One of them happens to terminate with $129 in positive net worth, and that's technically a success. And the other one terminates with negative $400 in net worth, and that's technically a failure. So you could have started retirement with a couple $1 million and gone through decades of spending and investing. And at the end of it all, a measly, $561 ends up being the difference between these 2 trials, between success and failure. Yeah, that is how the simulation works. It's not a bug, it's not a problem, but it is important that you understand these inner workings because Monte Carlo analysis can be presented to you as black and white, as successes and failures. But those 2 scenarios I just described, where after 30 years, $560 determine the difference between success and failure, those 2 scenarios are almost exactly the same shade of gray. It's just that we draw a little dotted line somewhere in that gray area, and that dotted line happens to divide positives from negatives. If we're not careful, we'll falsely believe that the dotted line actually separates black from white. It doesn't. It separates gray from gray from slightly darker gray, I guess. I reached out to Karsten Jeske. If you don't know Karsten, he goes sometimes by the nickname Big Earn, Big E-R-N, as in early retirement now, E-R-N, Big Earn. He's the author of the highly acclaimed financial independence blog, Early Retirement Now. And Earn, or I'll call him Earn, even though his first name is Karsten, he's definitely one of the biggest kind of foremost thinkers when it comes to safe withdrawal rate research, such as the 4% rule. And I was noodling on the problem I just described, or part of the problem of Monte Carlo analysis. So I wrote to him and I said, hey, Earn, my understanding is that retirement withdrawals can be a slippery slope. If when your retirement nest egg drops below a certain threshold, your risk of running out of money increases dramatically. Or perhaps said another way, as your retirement accounts drop, there is an exponential, not linear, there is an exponential increase in the probability that you eventually run out of money. The sequence of returns risk is a terrific example of this fact. So to that end, it begs the question, why do we pass-fail safe withdrawal rates based on $0 left in the account? We start retirement at 100% funded, we withdraw 4% or some other percentage per year adjusted for inflation, and usually markets have increased our nest egg to 200% or 300% or more by the time of death. And we define 0% as a failure, when really, I'm not interested in the point when we hit 0%. By that time, it's too late to change my future. I'm much more interested in when should I be worried? When do I need to take evasive action? Is it when my accounts hit 80% of where they started? Is it when they hit 50% of where they started? Is it something else? Is there an inflection point where you believe it makes sense for a retiree to seriously consider a change in course as their probability of failure has just become too high? So that was what I wrote to Ern, and he got back to me with something that he called a conditional success rate. I'll link to this article in the show notes. This conditional success rate helps retirees contemplate, it's been Y years since I retired, and my portfolio is currently down X%. How does that compare to history? How worried should I be compared to other time periods? I know my retirement hasn't failed yet, but surely I'm in a worse position now than other historic periods. Surely because my portfolio is down, I ought to consider tightening the belt and spending less. We can compare that to other probabilistic games. We can compare it to poker. Hey, I'm playing poker. Now that a king has come out in the flop, what's the conditional success of my pocket pair of queens? In Bayesian terminology, right, this is adjusting your priors. Your future probabilities change, or I guess I should say your current probabilities change based on this new information. So you have to adjust your prior assumptions. And part of my question essentially is, how should retirees adjust their priors as they move throughout retirement? More applicable to real life, how and when should retirees adjust their spending throughout retirement? This is a question, of course, that many people are attempting to answer in many interesting ways, but it's always good to have some analytical rigor behind whatever your answers are going to be. So here's a cool tidbit from Big Earn's research to kind of fill you in on my thought process. Imagine our retiree retires with $1 million and they have a 30-year retirement goal ahead of them. They're invested in 75% stocks and 25% bonds. They're following the 4% withdrawal rule and adjusting for inflation. And we're going to use real historical market data here. It turns out that this retiree, their rigid plan, right, which isn't dynamic at all, it's the 4% rule, it's going to fail in about 1.8% of all historical scenarios. But let's take that tidbit. It fails 1.8% of the time. Let's now fast forward 10 years into this person's retirement. Can we look at that 10-year mark and can we start to see if they're on the road to long-term success or the road to long-term failure? In other words, for some of the trials, by year 10, their accounts will have gone down. Sometimes they'll have less than $750,000. Sometimes they'll have less than $500,000. They started with $1 million. But then for other trials, their accounts will have gone up. They'll have more than $1.25 million after 10 years, even with all their spending. And if we had to guess, I would wager that we'll see far fewer failures from the second group, I guess maybe from the third group. We'll have far fewer failures from the people where their accounts have gone up. And we'll see more failures from the people who 10 years in, their accounts have gone down. That just seems to be the way that the sequence of return risk works. And this is called conditional probability. We ask, how does the probability change once we add a specific condition? Perhaps the condition is you made it to year 10 and you're already down to $750,000. Or the condition is you made it to year 10 and you're already up to $1.25 million. And what Big Earn's analysis shows is that if at year 10, if a retiree's portfolio was already down below $500,000, then they have a 13% chance of outright retirement failure. And they only have a 33% chance of dying with more than the $500K in their portfolio at that time. So there's a 2/3 chance that their portfolio is going to continue going down from there. And that's a scary thought if you're only 10 years into retirement. But if at year 10, your portfolio had already grown to 1.25 million or more, there wasn't a single outcome where you died with less than $500,000, not one. So in the first bad scenario we just outlined, you had a 2/3 chance of dying with less than 500,000. But in the good scenario, you have 0 chance of dying with less than 500,000. In fact, in the good scenario, you have a 75% chance of dying with more than $2 million. The takeaway, again, is that the early years of retirement absolutely set your path. Your end results are conditional upon the way your early years unfold. And therefore, if you can make smart, dynamic decisions in your early years, you will be shifting the conditional probabilities in your favor. A Monte Carlo simulation, for all its power, does not do this. It's on you to understand that fact. For me, one of the keys of understanding a Monte Carlo output also lies in percentiles. You've probably heard percentiles before. Wow, that baby is so fat. Yeah, he's in the 98th percentile for weight. Okay, that means that baby is heavier than 98% of his peers. So the 75th percentile shows us the result that is better than 75% of the other simulations and worse than 25% of the simulations. The 10th percentile shows us one of the worst outcomes. In fact, the 10th percentile is worse than 90% of the outcomes in the simulation. And by comparing different percentiles in a Monte Carlo run, we begin to understand our range of reality. Financial planning is very much about understanding your range of potential outcomes. Imagine I compare the 10th percentile to the 90th percentile. In doing so, I now understand 80% of my total range of outcomes. Then I can start to ask, well, just how disparate is that 80% range? If it's all over the map, say I retire at age 55 with $3 million, and the Monte Carlo simulations range from abject failure at the 10th percentile up to $15 million in terminal wealth at the 90th percentile. If it's that wide of a range, it tells me some interesting things. Specifically, it might tell me that the volatility in my portfolio subjects me to some significant sequence risks. Now, the good sequences are 5xing my money before I die, but the bad sequences are leading to retirement failure. So, I might want to play around with that result. I might want to adjust my allocation, my volatility accordingly. If I'm comparing the 99th percentile, though, to the first percentile, well, I expect that range of outcomes to be pretty big no matter what, because it contains almost all of the simulations, including the ones that have some really crazy sequences built into them. You might as well just be looking at the maximum and the minimum, the total range. But by cutting 5% or 10% or even 20% of the data on either end, that still leaves you with this big majority chunk of data in the middle that captures most of the possible outcomes and defines your likely range that you could have to deal with. If you're feeling particularly statistical, I guess, you might happen to know that 34% on either side of the mean average of a normal distribution, that 34% captures one standard deviation. So by measuring between the 16th percentile, that's 50 minus 34 in one direction, between the 16th percentile and the 84th percentile, which is 50 plus 34. So between the 16th and the 84th percentiles, you are capturing 68% of the results that occur within one standard deviation, either direction of the average. It's just a handy way of making use of Monte Carlo outputs without focusing so much on the worst of the worst outcomes or the best of the best outcomes. And then you can ask yourself, how many scenarios in that range that I've just described, how many of those scenarios end up starting to slip down that slippery slope toward running out of money? And how many of those scenarios end up on the other side where you're compounding faster than you can spend such that you die with 3 times or 5 times or 10 times what you started retirement with? So I think that's one really good way to look at Monte Carlo results. But then I also really recommend you understand a middle of the road failure scenario. So yes, a failure scenario. So let's say, for example, your initial Monte Carlo run has an 80% chance of success. That's great. I recommend you grab a couple of the outputs, a couple of the trials from the middle of the 20% of failure scenarios and really dig into those couple of outputs. Try to understand at what point in this failure trial did things start going off the track? What could you have done differently? Again, if you were allowed to be dynamic, if you're living your life, what could you have done differently in that trial, specifically in terms of spending less? How many years of lowered spending and what magnitude of lowered spending could have turned that particular failure into a success? I think that will really help you understand, again, that's a really good way of going beyond the surface level results of a Monte Carlo and really digging into the detailed results. The very last thing I'll go over in this episode, what are some other common Monte Carlo mistakes? A really easy one to avoid, and this can be very consequential, is understanding how your particular Monte Carlo software handles inflation. For example, do you need to account for inflation when you input your spending numbers? Or does the program ask you for a particular rate of inflation and then it automatically inflates your spending numbers for you? Do you need to account for inflation in the portfolio return assumptions or not? Nominal returns or real returns? Considering long-term inflation averages out to like 2 to 3% per year, you need to get inflation right. You need to make sure you model it accurately. Double counting inflation, thus reducing your real return by an extra 2 to 3% per year, creates way more failure than reality ought to, but then not counting your inflation at all, thus increasing your real return by an extra 2 to 3% return, well, that's going to create way more success than reality otherwise would. So you've got to get inflation right. Overall, these Monte Carlo programs, they're great tools to examine where you're at and to understand the range of possibilities that your future might go through. But importantly, your unique future, it only partially exists in that range of possibilities that a Monte Carlo is going to create for you. There are a lot of dynamic aspects in retirement planning, and a Monte Carlo analysis captures some of that dynamism amazingly well, but it does not capture all of it. Other parts of retirement, the Monte Carlo has to assume are static, and then you, the user, you have to infer from there. So if I didn't answer any specific questions you have about a Monte Carlo analysis, by all means, feel free to email me to jesse@bestinterest.blog. I know this was a wonky one. I don't expect any of us to be out there writing our own Monte Carlo software or getting statistics PhDs to understand what's really going on under the hood. It's just one of those things where a Monte Carlo, like many things in this world, it's got a bit of that double-edged sword to it. And as long as you understand how to use that sharpness for your benefit and not to get injured by it, I think you'll be in a good place. So thank you, as always, for listening.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.